Okay, so in this video, we're going to start to look at what we call the economic efficiencies. And it's really important that you know where to find these efficiencies on a lot of your diagrams because it's a really important part of the whole evaluation of what happens in markets if you can actually look at the efficiency in those markets. Okay, so there's basically four types of efficiency I would suggest that you need to know. There is another one in economics called Pareto efficiency, but I'm not going to talk about that in this one. These are the main ones that you look at in this section of the course when we're looking at the theory of the firm. So you've got allocative, productive, technical or X efficiency, and then dynamic efficiency. Now, it's likely you've come across these before. So allocative efficiency is when you are allocating the scarce factors to where they are most highly valued. That's the key phrase that you've got to use. And you can find it in different places. You can find it where demand equals supply. If there's no market failure, that really first part of the course, when demand equals supply, you have got allocated efficiency. You've maximized your surpluses, consumer and producer surpluses. You have allocated the factors of production to where the welfare of the economy is at its maximum. When it comes to a firm, it's where price equals marginal benefit, always equals marginal benefit, and where that then equals marginal cost. Okay, and you can also find it at some point on the PPF. So allocate efficiency is not at any point of the PPF, it's at one of those points on the PPF. That's the point where you've allocated the factors of production to where they're most highly valued. Okay. Productive efficiency is when you have some output level as a firm and you've achieved all the economies of scale, i.e. at the lowest point of the ATC curve. It is also, and this is really important, it's achieved when your productivity is maximized. So if you remember the average product curve and the average cost curve and how they relate to each other, that's why we did that. When the average product is at its peak, the average cost is at its lowest point. So when productivity was rising, average costs were falling. When productivity was falling, average costs were rising. And so hopefully you could remember that, and you could see that when the average product, which is productivity, the average productivity for your workers is at its maximum, that's when average total cost is at its minimum. Okay, it's also when the economy is producing on the PPF. So any point on that PPF would be productively efficient. Okay, technical and X inefficiency. All that says is we're producing at on the ATC curve at whatever level of output we have. So it doesn't matter what the level of output is. We'll see this in the diagram in a minute. You are producing on the ATC curve. Okay, and dynamic is always then basically efficiency over time. You're always investing in the latest technology, latest innovations, because you've earned supernormal profit in the past, and that gives you the ability to do that investment. And because you might actually keep the supernormal profit in the future, another reason why you'd want to invest to reduce your average cost, to raise your profits, and you keep your profits. So I always call it the ability and the incentive that comes from supernormal profits. So let's have a quick look at all of those in a diagram. So this is your first one, that in the market, here's your price, here's your quantity. This is your marginal private benefit, marginal private cost. These are your surpluses, if you remember. This is a simple demand and supply diagram. And allocative efficiency says basically it's the optimum allocation of the scarce factors of production in the market, and it's the output where demand equals supply if you don't have market failures. And so when you bring in market failures, that's why the market is failing. It's failing to allocate the scarce factors in the right way. Okay, so hopefully that makes sense to you. And again, you must be able to work through the fact that, at any level of output, any quantity here, let's take this one here, you're saying this is the benefit, the extra benefit gained from the consumers when the market produces it. This is the extra cost, marginal cost, of producing those goods That's the cost of using up those scarce factors of production. And so therefore, if you are here, you could increase your output and increase your welfare in the economy. Okay, so it is where the consumer and the producer surpluses are maximized. That's one way of looking at allocative efficiency. Okay, so the welfare of the economy, remember, is adding up those two surpluses. If you can't remember that, go and have a look at the video on the surpluses. Okay, all right. Another way, when we get into the theory of the firm, here you've got this side here is perfect competition. This is the demand and the supply in the industry that feeds across, and every single firm then is so small, remember, it can basically sell what it wants at this price. So the demand equals the average revenue, and in this case equals marginal revenue. Because of that, when you set MR equal to MC, the price also equals MC. So price is always a reflection of the marginal benefit that the consumer gets for the good. And so in this case, there's marginal benefit equal marginal cost, allocative efficiency. So all firms in perfect competition, allocative efficiency. In a market where you have a downward sloping demand curve, that could be monopoly, it could be oligopoly, monopolistic, the MR is below the AR, and because of that, when you do that profit maximizing here, look, okay, the price is up here, whereas this is the point of allocative efficiency where the price would have been equal to the marginal cost. So in any market that is not perfect, you are not going to get allocative efficiency. Productive. Okay. I think most people remember it. It's at the lowest point of the ATC. So here's your ATC. Marginal cost always cuts the lowest point. So it's when you are producing at any point at the lowest point of the ATC. But as I said just now, really important that you remember the relationship between average cost and average product, that basically average total cost is at its lowest point, then the productivity, average product, must be at its highest point. Okay, so it's about average product, not marginal product. That would be lowest marginal cost. But it's the average product, the productivity of your average worker, the average productivity of workers is at its highest, and that's why it's productively efficient. Okay. This is slightly harder. See if you can remember this. In the syllabus, it says we've got to turn the short run to the long run, but this is where we start to talk about technical or X efficiency. So you have a series there in color here. The blue one here is a short run average total cost curve with 1 unit of capital. So K equals 1 is 1 unit of capital. K equals 2 is 2 units of capital. So you can have 2 machines in this business. And the argument is that as you increase your output here in the firm, you're on this short run average total cost, and then you hit a point here, and the firm then has to make a decision. Now in the short run, all it can do, 1 unit of capital is fixed in the short run. Okay, at least one factor is fixed. We normally call it capital. In the short run, we have to move up here. But in the long run, what the firm can do is it could get a second unit of capital and move on to the red average total cost curve. So it could either keep 1 unit or employ 2 units by another one, and it moves down to here. Same at point 3. What are we going to do as a firm? We could keep 2 units of capital and start to see our average cost rising, or we could move on to the green one, which is where you buy 3 units of capital. So in the long run, you adjust the amount of capital and labor that is in the industry. So therefore, if you are doing that and you're operating at any of these quantities, and you are operating at 0.1 or 2A or 3 or 3A, i.e. you are on your long run, because this becomes the long run average total cost curve, then you are technically or X efficient. Okay, so hopefully that makes sense to you what this X in efficiency is. It's at any level of output. Okay, whether you're here, you have adjusted your labor and your capital until you're on the ATC, the long run ATC curve. Okay, so what we're talking about here, and you can see it, I hope, just to confirm what we're saying about X efficiency, is that this blue line here is the long run ATC curve. It's been smoothed out now. And so any point when you have adjusted your labor and capital so that you are on the ATC, you are X efficient. If you haven't adjusted it, you're X inefficient. Okay, and sometimes they call that organizational slack as well, but that is X inefficient, X inefficient, X inefficient, X inefficient. Any point on it is X efficient. So hopefully that makes it clear. It is about whether or not you're adjusting as a firm your labor and capital units to get to the very lowest average cost that you can at that level of output. Not the lowest point of the ATC, that's productive efficiency, but it's at any level of output whether you can actually get onto the ATC. Okay, so dynamic efficiency, the last one, is a really important one, which tends to be more difficult to explain, and there's no point on the diagram for this. What this is talking about is a situation in which firms are able to introduce the latest machinery technology, the latest innovation, so you're always producing at the lowest possible cost. You've always got the most efficient means of production. Okay, it's a large factor behind what we call sustainable economic growth in macro as well. And the point that you've really got to see is it's achieved when firms make supernormal profit over and above normal, remember, and in the long run then they use this profit to make those investments. So this is something that you would often use as sometimes an evaluation of firms that make profits, maybe monopoly or some oligopolies, collusive oligopolies, for example. You would say that they're making supernormal profit, their prices are higher, bad for the consumer, get all that. But really, what you then say is, however, they are able to invest that profit. And there's two things. The best thing to say, they are able to invest and they have the incentive to make those investments. In other words, they've had the profits from the past, they've built them up, they can produce, introduce new machines, and they've got the incentive to do that, because if they do that and they reduce their cost and they make supernormal profits again in the future, they are going to keep them. So they have a ability to do it and incentive to do it. Okay, they won't get competed away as they would if there was some competition or if there was sort of monopolistic competition. Okay, so dynamic efficiency is often a really good one to use for evaluation when you say that some firm structures have got some supernormal profits. So hopefully that gives you a good idea, a good run through of the efficiencies that you can use. And as I say, use them when you're answering questions, when you're looking at different market forms, when you're saying, say a price cap is put into a market and that sort of thing, and profits are affected, or, have we got closer to allocative, productive? Are we going to be more dynamically efficient? So hopefully that's of help.